Welcome back to the Deep Dive, where we tear through the source material, the articles, and the core research so you can cut straight to the central, enduring insight.
And today, we're doing a true forensic investigation.
We're looking into one of the most significant and certainly most provocative technological and economic events of the 21st century, the Bitcoin genesis.
We have stacks of academic papers, economic analyses, historical documents, you name it. And this isn't just a history lesson, right?
No, not at all.
It's an exploration into the motivations behind the code, the technological breakthrough that finally solved this ancient problem of digital trust, and crucially, the almost unbelievable institutional surrender.
The surrender by the very banks and financial titans who spent over a decade proclaiming this whole thing was a fraud.
Exactly.
Our mission today is to uncover the absolute why. Why did this ghost, Satoshi Nakamoto, create this system? And why, 15 years later, are the biggest asset managers in the world,
The ones who swore they would never touch it.
the very same ones, now rushing to become its most enthusiastic buyers? The entire trajectory of this deep dive, it really hinges on a single central clue.
A clue hidden in the very first lines of code ever written.
Mm-hmm.
That's the key piece of forensic evidence. On January 3rd, 2009, this unknown entity, Satoshi Nakamoto, releases the Bitcoin code, activating the network.
And right there, inside the very first block of data, what everyone calls the Genesis block.
Yeah, Satoshi didn't just log some generic transaction. He logged a statement of defiance.
He manually inserted this secret, non-negotiable message. It's a headline, clipped right from the front page of the Times newspaper.
And for posterity, forever etched into this immutable digital ledger, the headline reads, "Chancellor on brink of second bailout for banks."
Wow.
What stands out here immediately is just the unmistakable intentionality.
You can't miss it.
No. This permanently establishes that Bitcoin was, first and foremost, a political and economic protest against a broken, centralized, and frankly untrustworthy banking system.
It wasn't just some new digital cash system.
Not at all. It was architecture built to reject the 2008 failure, where systemic gambling destroyed the global economy and then demanded a massive taxpayer-funded rescue.
So it was effectively a technological declaration of independence.
That's a perfect way to put it. Independence from a centralized system that had proven itself mutable and corruptible.
And for the next 15 years, that system, Wall Street, London, Frankfurt, they fought this declaration fiercely. They mocked it. They tried to ban it.
They called it rat poison, a criminal's toy.
Right. And yet today, the same voices, the same institutions, they're the biggest buyers. They're filing for ETFs, allocating billions.
And our investigation will uncover precisely why the smart money finally capitulated, why they finally realized they couldn't possibly destroy this decentralized economic organism that's secured by pure mathematics, cryptography, and verifiable energy.
Okay, so here's our path through this deep dive. We're going to unpack the original problem that Bitcoin solved, the fundamental dilemma of digital trust.
And the need for a middleman.
Exactly. Then we will break down the ingenious architectural solution, the consensus mechanism, the blockchain, and the proof of work that secures it all.
After that, we'll get into the mechanics of its non-negotiable scarcity.
The 21 million coin limit, which is the asset's golden feature. And finally, we will analyze that dramatic institutional pivot, asking what that massive surrender means for you, the individual investor, looking for resilience in your own portfolio. To really appreciate the power of that headline of the Genesis block, we can't just look at the date, 2009. We have to immerse ourselves in the atmosphere of late 2008.
Oh, absolutely.
We have to recall the collective shock and the corrosive cynicism that surrounded the government bailouts.
Absolutely. The atmosphere was one of profound public betrayal. You had these massive financial institutions, the ones entrusted with the entire world's financial stability, engaging in highly leveraged, just reckless gambling with complex instruments they barely even understood themselves.
And when the music stopped.
When it stopped, and they failed spectacularly, the consequence wasn't just a market correction. It was a global economic collapse.
But the truly toxic moment wasn't even the failure itself. I mean, markets fail. That's natural. The crisis of faith came when governments, using taxpayer money, stepped in to shield the very institutions responsible for the collapse.
Right.
This demonstrated a fundamental shift. The risk was socialized, the public bore the cost of the bailouts and the recession, but the profits and bonuses were privatized. They were protected. The system was just exposed as profoundly unfair.
And fundamentally untrustworthy.
Exactly.
That sense of moral hazard is key to understanding the code's motivation. This wasn't just a flaw in regulation. Satoshi recognized that the failure was architectural.
What do you mean by architectural?
The traditional financial system is centralized. There's always a single point of failure, a central committee, a central bank, a central government that holds all the power and the single mutable record of truth.
So they can change the ledger.
They can. And centralization, as 2008 proved, creates an irresistible concentration of corruptible power.
We saw this sort of manifest in the government's response, what we now call quantitative easing, or QE.
The source material details how central banks, especially the U.S. Federal Reserve, reacted to the crisis by just injecting massive liquidity into the system.
They weren't just injecting liquidity, though.
No, they were proving, on a scale never before witnessed, that fiat currency is infinitely reproducible. The speed and scale of money printing were just staggering.
It was a clear demonstration that the value of the dollar, or any fiat currency, it's not backed by anything scarce. It's backed by the decree of a government.
A government which, as 2008 showed, could choose to print away obligations rather than face painful financial reckonings.
Which brings us back full circle to that intentional clue, that headline permanently inscribed into the code. It wasn't just a nod to current events.
No, it was a precise technical mechanism to encode the political raison d'etre of the project.
You have to remember the technical reality here. Once the Genesis block was written and subsequent blocks began building on top of it, that headline became permanently fixed.
It cannot be edited. It can't be removed or negotiated away. By embedding the failure of the centralized fiat banking system right there, Satoshi ensured that the origin story, the purpose of Bitcoin, would be immutable for all time.
It's the closest thing the digital world has to carving a mission statement onto the cornerstone of a new economic paradigm. It's saying, this structure is built because the old one failed, and here is the permanent evidence of that failure.
And if we expand on that, it ties directly into this concept of Bitcoin as a technological declaration of independence.
Okay.
It rejected the need to place trust in mutable institutions, in fallible humans, and in governments that can perpetually debase the currency. Instead, it proposed replacing that vulnerable human trust with transparent, verifiable mathematics and code. The code becomes the law.
And the law is open for all to inspect. Now, setting the stage for the dramatic irony to come, this radical vision immediately translated into a long, drawn-out war.
A war waged by the very financial establishment it was protesting against.
It was a 15-year resistance, relentless in its intensity.
Oh, yeah. Initially, they tried the classic approach, dismissal. They ignored it, treating it as a bizarre, niche hobby for cryptography nerds, arguing that it couldn't scale and would just fizzle out.
When dismissal failed and the market cap started to grow, they shifted to active hostility.
They weaponized regulation. They tried to lobby governments to ban it outright or to impose restrictions so onerous that it would strangle the industry in its cradle.
And they characterized it purely as a mechanism for crime and money laundering, trying to cast this moral shadow over the entire asset class.
Their fundamental misjudgment, though, was rooted in fighting a centralized war against a decentralized enemy.
That's a great point.
They were looking for a CEO to arrest, a headquarters to raid, a central point of failure to exploit. But because the network is peer-to-peer and decentralized, attacking one node just strengthens the others.
They were fighting mathematics.
And a global economic incentive structure. That realization that they couldn't kill it, that's the necessary setup for the institutional surrender that followed. But it only makes sense once we understand the underlying genius of the solution itself.
Okay, let's unpack the core technological genius, because the code's effectiveness is what ultimately won the war.
Right.
We established the motivation, the protest against centralized failure. Now, we have to understand the engineering challenge that had stumped cryptographers for decades. We have to define the problem first. The double spend dilemma.
The double spend problem is elegantly simple to state, but it was the insurmountable hurdle for creating digital cash before 2009.
So how do you ensure that a digital token, which is fundamentally just information, can be treated as a scarce, non-reproducible object, like a physical coin?
Exactly. In the physical world, money is inherently scarce. If I physically hand you a $20 bill, I no longer have it.
The transfer is one-to-one, instantaneous, and final.
Physical scarcity is built into the medium. But digital information operates under completely different rules. As you noted, if I send you a photo, I'm just sending a copy. We both have it now.
Right.
If I could do that with a digital currency, send one Bitcoin to Alice, and then immediately turn around and send the exact same Bitcoin to Bob, the currency would instantly devalue to zero.
Because scarcity would be lost. The trust would be gone.
Instantly.
So before 2009, how did every digital transaction system, Visa, PayPal, banks, solve this?
They all relied on a trusted intermediary,
The middleman.
a middleman. These intermediaries served as the central authority holding the single master record. Let's call it the historical tally, or the central ledger.
But they were the scorekeeper?
The ultimate scorekeeper.
Yeah.
Their function was essential. They recorded who owned what, and the moment a transaction occurred, they logged it and verified that the sender's balance was reduced, thereby preventing a fraudulent second spend.
But this introduces the very danger we saw in 2008. The system worked, but it required total trust in a fallible, centralized party.
Exactly. And the concentration of power is immense. The bank, as the guardian of that central ledger, has the authority to freeze your funds, block specific transactions.
And, as we thought, they have the ability to misuse or gamble the aggregate contents of the ledger itself, relying on the guarantee of a government bailout if they fail.
They were the trusted party, and they repeatedly broke that trust.
That failure prompts Satoshi's radical inquiry. He essentially looked at the global financial system and asked, can we design a system where the historical tally, the record of all transactions, is shared by everyone, constantly verified, but controlled by absolutely no one?
That is the technological leap. And it required solving a long-standing computer science puzzle.
The Byzantine Generals problem.
In an economic context, yes.
Okay, help the listener understand that problem without getting bogged down in the military history. What's the fundamental issue here?
Imagine several generals surrounding an enemy city. They need to agree, by consensus, on a single plan, either attack or retreat, at the exact same time to succeed.
And they're separated, so they have to communicate through messengers.
Unreliable messengers. And the core problem is compounded because there might be traitors among them sending false messages.
So the challenge isn't just distance. It's confirming that the message is authentic and ensuring all the loyal generals agree on the same command at the same time if one general gets a false message or gets the message too late.
The whole mission fails, catastrophically.
Okay, so how does that relate to digital money?
In the context of digital money, the generals are the thousands of computers on a network. The consensus they need to reach is, did Alice send Bob one Bitcoin, or is this a fraudulent transaction?
A double spend.
Precisely. If the network can't agree on a single, unified chronological truth, a single order of events, the system collapses into chaos. Before Bitcoin, the centralized bank was the central commander that forced consensus by just saying, this is the truth.
You just had to trust their record.
But Satoshi proposed a decentralized solution. So how do you get thousands of untrusting, geographically separated computers to agree on a single, unified historical tally without a central commander?
The solution is the blockchain.
The blockchain, secured by the mechanism we call proof of work. The blockchain acts as a shared, public, replicated digital ledger.
The analogy we often hear is like a Google Doc.
It's a useful starting point. Everyone can view the total history of transactions, ensuring transparency. But the key difference is that no single party, not even Satoshi himself, can edit or delete historical transactions.
So this decentralized nature provides the security. If one computer or node tries to broadcast a fraudulent transaction, a double spend,
The moment that transaction hits a network, it creates a discrepancy with the thousands of other copies of the ledger.
and that discrepancy is fatal to the fraud.
Yes. The network, by mathematical consensus, rejects the invalid version because it doesn't align with the legitimate chronological history that the vast majority of the network has already agreed upon.
It's the distributed nature of the ledger that eliminates the single point of failure.
And that's what makes the network trustworthy. Trust is enforced not by a CEO, but by pure math. The genius is that this system makes it easier, cheaper, and much more profitable, to be honest, than to cheat.
We have the motive, the protest, and the high-level solution, which is this decentralized consensus. Now, we need to dive into the gritty engineering details that make the system work minute by minute, securing billions of dollars globally. How does this shared global historical tally actually get written?
Okay, so the process is cyclical, and it happens roughly every 10 minutes. The blockchain is built in sequential batches or blocks.
So every 10 minutes, a new page of block is generated, and this page aggregates all the validated transactions that have been broadcast to the network in that period.
Things like host speaker, send expert speaker 0.5 Bitcoin. And to maintain integrity and efficiency, these individual transactions are summarized into a single compact digital fingerprint called a Merkle root.
Think of it as an ultra-efficient summary of everything in that block.
Exactly. It lets the network instantly verify the block's integrity without having to check every single transaction individually. This root, combined with other data like the timestamp and the fingerprint of the previous block, forms what's called the block header.
And linking to the previous block's fingerprint, that's the critical step that creates the chain, right?
That is the chain. Each block is cryptographically chained to the one before it. If you try to change one letter in a transaction from 3 years ago, you instantly change the unique digital fingerprint of that block.
Which means the next block's fingerprint is now incorrect.
And so is the one after that, and the one after that, all the way up to the present. You break the entire chain.
So that's the immutability. But the actual work, the security, is ensuring that the person proposing this new valid block is legitimate. This is where the miner comes in.
Right. The miner, which is really just specialized computer hardware operating all over the world, competes to solve an incredibly complex, resource-intensive cryptographic math puzzle. This is proof of work.
So what are they trying to do?
They're trying to find a specific numerical input, it's called a nonce, that when combined with all the block data and run through a hashing function, produces an output that meets a specific, extremely difficult criteria.
Like an output that starts with a whole bunch of zeros.
Exactly. And it sounds like a guessing game that requires immense brute force.
Because it is.
It is entirely brute force. The only way to find the correct nonce is to try trillions upon trillions of guesses per second. The network constantly adjusts the difficulty of this puzzle to ensure that, on average, only one computer succeeds every 10 minutes.
And the first miner to find that magic nonce, they win the right to propose the new validated block.
And add it to the global chain.
And their reward for all that work.
They receive the block subsidy, which is newly minted Bitcoin, plus all the transaction fees from that block. This reward is the financial engine that fuels the entire network. It incentivizes billions of dollars of computing power to perpetually validate and secure the ledger.
But I have to ask the critical question the sources always raise. Isn't this proof-of-work mechanism fundamentally wasteful? All that energy.
That is the essential trade-off, and the answer lies in the security model. The energy cost is the trust mechanism. It's what makes forgery so mathematically and economically prohibitive.
Explain that.
If a bad actor wanted to cheat, say, to double spend or insert a fake transaction, they would have to redo the proof of work for that fake block and every subsequent block that has been added to the chain since.
So if I change an old transaction, I break the chain of fingerprints, and I have to immediately outcompete the entire honest global network by resolving all those puzzles faster than they can.
Precisely. To successfully rewrite history, you need to control over 51% of the entire global mining network's computational power. The cost in both hardware and continuous energy to do that is exponentially higher than any reward you could possibly gain from cheating.
It's truth by consensus, secured not by a decree, but by verifiable, costly energy.
Exactly. And that's why institutions started calling it digital gold.
And speaking of gold, this brings us to the feature that moved Bitcoin from an interesting cryptographic concept to an irresistible investment asset for the institutional smart money.
It's absolute non-negotiable scarcity.
You have to contrast this with our modern financial reality.
As we discussed, we live in a world where central banks just routinely engage in massive monetary expansion. The source materials clearly show the M2 money supply just exploding globally after 2008. Fiat currency is infinite.
And even traditional physical assets like gold, while scarce, are not absolutely fixed. If the price of gold skyrockets, we find more of it.
We dig deeper, we invent new technologies, the supply responds to demand, even if it's constrained.
Bitcoin stands alone. It is the only asset class in economic history with an absolute mathematically defined, unchangeable hard cap.
This is the non-negotiable term of the contract. There will only ever be 21 million coins, period.
21 million.
No amount of demand, no committee vote, no change in politics, not even Satoshi himself could alter that number without destroying the network's consensus. And that immutability is the financial genius. And that fixed supply is reinforced by the mechanism known as the halving.
Explain the halving for our listener. How does it work?
The halving is a programmed event where the reward given to miners for creating a block, the new supply of Bitcoin entering circulation, is automatically cut in half.
And this happens roughly every 4 years.
Every 4 years, like clockwork.
Yeah.
In 2012, the reward dropped from 50 Bitcoin per block to 25, then to 12.5, and so on.
So every 4 years, the rate at which new supply enters the market is drastically reduced. We have a system where demand is constantly growing while the incoming supply is mathematically throttled down.
That creates the ultimate definition of a hard asset. It's anti-inflationary by design.
In a world facing monumental global sovereign debt, what is it, around $35 trillion?
According to our sources, yeah. And in that world where traditional safe havens are being diluted by fiat expansion, Bitcoin's fixed supply is its greatest selling point, its property rights encoded in mathematics. And that simple, rigid truth is what forced the institutional world to abandon its contempt.
The stage is set for the greatest irony of this entire investigation.
Mm-hmm.
The system was conceived as an architectural rebuke of the centralized banks in 2009. Flash forward 15 years, and those very banks and asset managers are in a desperate race to scoop up the remaining supply.
Let's just revisit the historical context of their disdain. The hostility was visceral. It went beyond skepticism.
Oh, yeah. We saw leaders like Jamie Dimon, CEO of JP Morgan Chase, famously call it rat poison, not just once, but multiple times.
Warren Buffett called it rat poison squared and delusion. They spent years trying to maintain the fiction that this was a fringe asset for criminals or just a speculative bubble destined to pop.
They truly believe they could kill it through regulation, reputation attacks, or just by starving it of institutional liquidity.
But at some point, around 2023, the mathematical reality of its market cap and its flawless operational uptime just became too massive to dismiss.
It became undeniable.
The turning point was force, not by technology, but by fiduciary duty. Institutional investors realized they were failing their clients by denying them access to the best-performing asset of the last decade.
An asset that successfully offered a hedge against the very inflation and debt crisis the traditional system had created.
Right.
Let's talk about the symbolic figurehead of this surrender, Larry Fink, CEO of Blackrock.
The largest asset manager in the world.
Managing trillions of dollars. Watching Fink's pivot is the clearest visual representation of the establishment capitulating. He went from calling it an index for money laundering to dramatically proclaiming it digital gold for the 21st century.
That 180-degree ideological U-turn was not a philosophical conversion. Let's be clear about that.
No.
It was a cold, hard commercial decision. BlackRock's mandate is to maximize returns and mitigate risk for their clients. They are masters of adapting to market demands, and the demand for a non-sovereign hard asset became overwhelming.
So let's analyze the true reason they caved. Why did BlackRock decide they needed to launch a spot Bitcoin ETF?
The simplest answer is the nature of their clientele. When BlackRock or Fidelity move, they're not really serving retail investors. They're serving massive corporate pension funds, sovereign wealth funds.
And ultra-high net worth individuals managing generational wealth.
Exactly. These entities manage capital on a macro timescale, and they saw a profound structural risk in the traditional financial system.
They needed what we might call the ultimate tail risk hedge, an insurance policy.
A schmuck insurance policy.
Yes, against the potential collapse or severe degradation of the traditional bond and fiat markets.
Absolutely. Our sources detail this profound global debt environment. When global debt sits at $35 trillion and rising, the primary way governments manage that debt is through inflation paying back debts with cheaper dollars. This inflationary environment systematically destroys the value of traditional fixed income assets, like 30-year U.S. Treasury bonds, which used to be the definition of a safe haven.
So the institutions realized they were trapped in a system built on infinite supply and perpetual debt, where the so-called safe assets were actually carrying extreme systemic risk.
They needed a non-correlated asset, something with zero counterparty risk, meaning if the bank fails, the asset doesn't disappear.
And Bitcoin, secured by math, was the only answer that fit the bill.
Furthermore, the ETF structure solved their regulatory and logistical problems. Institutional investors are heavily regulated. They can't just go out and hold complex digital assets directly.
They can't deal with the complexities of digital wallets, private keys, cold storage.
No, but the ETF vehicle allows them to buy shares that track the price of Bitcoin, while BlackRock manages all that complexity behind the scenes, meeting all regulatory requirements.
It transformed the asset from cyberpunk money that required technical skill
into a portfolio asset that you can buy in your normal brokerage account.
That single regulatory approval driven by the demand of their clients was the moment the asset became fully legitimized. The floodgates opened.
And this is the core irony we have to take away from this investigation. The technological rebels created an asset to burn down the banks.
But the banks, unable to defeat it, were forced commercially to absorb the asset and make it a central pillar of their investment strategy.
They couldn't kill the code, so they bought the code.
Which raises an important critical point. If institutions like BlackRock now manage billions of dollars worth of Bitcoin via these ETFs, storing the underlying asset, aren't we just re-centralizing control?
That's a crucial distinction, and the answer is no, not fundamentally. While the ETF structure centralizes custody for regulatory ease, the underlying asset remains decentralized.
So they can't change the rules.
BlackRock can hold billions of coins, but they cannot print more. They cannot change the 21 million limit. They can't alter the block reward or the halving schedule. The fundamental economic rules of the asset remain completely beyond their control. They are renters of the asset, bound by the mathematical rules of the decentralized network.
Our forensic investigation concludes with the institutional surrender. Bitcoin survived the war, forced the hands of the largest financial firms, and is now integrated into the global financial architecture.
But what does this mean for our listener who is assessing this asset today?
Well, we have to start with the reality check on volatility.
The source material confirms Bitcoin has been, by a considerable margin, the best performing asset of the last decade. It has provided asymmetric returns that just dwarf traditional investments. However, this performance comes with wild volatility. We have seen crashes of 70% during bear markets, only to be followed by parabolic growth of 300% or more during bull cycles.
Volatility is not a bug, it is the price of admission.
For a newly decentralized, non-sovereign asset, yes.
Now, we can synthesize the institutional playbook. Based on how the smart money is approaching this volatility, we can distill 3 practical, actionable nuggets of knowledge for the individual investor.
The first and most foundational lesson is the custody rule.
This is the primary lesson drawn from systemic failures like the collapse of FTX.
Right. If you leave your Bitcoin on a centralized exchange, you do not possess the asset itself. You possess a liability, an IOU from that exchange. If the exchange is hacked, or if it mismanages funds like FTX did, your money can vanish instantly.
So the sophisticated investor's mandate is non-negotiable. Learn to use a cold wallet.
You have to. This means securing your private keys, the actual cryptographic code that grants access to your funds, on a physical hardware device, disconnected from the internet.
This step moves the asset from being a speculative token subject to counterparty risk to a truly hard asset, where your property rights are secured by math and only you hold the keys.
It is the financial definition of freedom.
The second part of the playbook focuses on the time horizon.
Smart money completely disregards the daily noise. The short-term price swings, the Twitter sentiment that drives retail trading. They ignore all of it.
You cannot day trade an asset that's built around a 4-year economic cycle.
No. Institutional investors are focused entirely on the macro mechanisms, specifically the halving cycle. Since the halving mathematically guarantees increasing scarcity, it has historically acted as a reliable catalyst for major price appreciation. They're betting on the code's design.
Their time horizon is 3 to 5 years, aligning with those halving events.
Exactly.
And finally, perhaps the most critical insight for the portfolio builder, allocation.
They are not all in.
Far from it. The institutional approach is measured and strategic.
Correct. They view this as a volatility management tool and the ultimate insurance policy. The consensus allocation among sophisticated financial managers is consistently a small percentage, typically 1% to 5% of the total portfolio value.
That small allocation serves as the primary systemic insurance policy.
The logic is that if the traditional system remains stable, that small 1 to 5% may underperform slightly, but the risk is managed.
But if the system breaks, if the $35 trillion debt crisis spirals, or if fiat currencies experience hyperinflation, that small 1% or 5% allocation provides an outsized hedge and protects the overall portfolio from systemic loss.
So, the verdict forces a final debate upon the listener. Is it too late to buy? Or are we simply at the beginning of the digital gold era, now that the institutional rails have been fully laid?
The answer hinges entirely on your perspective on the future solvency of governments and the stability of modern monetary theory.
If you believe the current debt-driven centralized system is sustainable, then perhaps Bitcoin is overvalued.
But if you accept the institutional insight, that stability of value should be based on transparent, decentralized mathematics and fixed supply, rather than the shifting decrees of any central bank.
Then this adoption phase, moving from criminal toy to portfolio asset, is still relatively early. It forces you to consider the unique implications of owning an asset where the supply is absolutely fixed. If the system continues to break, that small allocation is not just code. It represents a form of financial resilience.
Financial freedom. Hashtag outro. We've traced this incredible origin story from the architectural rebuke encoded in the Genesis block in 2009 through the technological marvel of solving the Byzantine Generals problem.
Leading to the creation of absolute non-negotiable scarcity capped at 21 million coins.
And we bore witness to the astonishing institutional capitulation, where the biggest asset managers on the planet went from calling it rat poison to fighting to integrate it.
Thereby legitimizing it as a necessary portfolio asset in the face of structural global debt risks.
The lesson from the smart money playbook is clear. The future belongs to the owners of hard assets. That knowledge, paired with secure self-custody and a long-term cyclical time horizon, is the essential takeaway.
We've spent a great deal of time discussing the energy required to secure the network, the proof of work. It's what makes the system immutable, but it's also the most common point of criticism.
It is. And so we want to leave you with one final provocative dilemma that builds on that energy discussion. It's the ultimate ethical and economic question that secures this entire network. And it's something for you to mull over as you conclude this deep dive.
Does Bitcoin fundamentally waste energy? Or does it utilize that energy expenditure to secure the world's only incorruptible fixed supply money?
Is the verifiable energy cost truly worth the financial freedom and systemic insurance it promises?